Hello, I'm James Kaufmann, Registered Representative at American Portfolios Financial Services and the owner of JK Tax Strategies. I'm here today to talk with you about tax-efficient investing. Tax-efficient investing involves careful planning and starts with the client's tax return, which is needed in determining how much tax a client can save. Also, being an accountant, I see that many people have never read their own tax return. They tell me they have a person who is good, and the bottom line is they get a refund. However, by reviewing a tax return, I can show people how this is widely misunderstood. Many deductions or credits are left off, and almost always people and tax preparers don't discuss some of these items. It's the total tax line that matters, not whether a refund was issued or there was a balance owed. That is just the result of overpaying or underpaying. Looking at investment and interest income shows me where people have some of their money. By digging a little deeper and asking questions, I can determine the purpose, the time frame, goal, and plans that people have for some of these assets. This can help people a lot. Let's take a look at an example. We'll take Mr. and Mrs. Smith. They have taxable interest on line 8A from a bank account or a CD or a savings account. Sometimes people don't even know what a CD is. They just know it's there. What they don't know is, depending on where you list that CD's interest, could allow you to pay Uncle Sam less by taking money out of your right pocket and putting it into your left. Move the earnings onto line 8B, tax exempt. Let's look at the math in a 33% bracket. Take a bank account on the left side, currently paying 1.5% interest. 0.5 goes to tax, and people keep 1%, versus a tax-exempt municipal bond fund paying 4%. There isn't any tax. That's 4 times the earnings. It's equivalent to 5.97 that's taxable. Now, let's take a hypothetical investment of 30% in a tax-managed stock fund and put the remaining 70% into a high-quality municipal fund. Adjustments can be made depending on the client's risk profile. Let's say the average return on the stock fund is 7% and the municipal fund average return is 4%. We'll consider that total return approximately 5% without the taxes. It's equivalent to 7.46% taxable. Let me ask, what bank pays this rate? None. This may not sound that complicated, but not looking at strategies like this could be costing you. Today, with the enormous stimulus and government spending, many people are in agreement taxes will be going up. By taking the time to look over and reevaluate, your 1040 with a professional like myself could save you hundreds or thousands. You can contact me using the information that follows below for a free review. Thank you.